Good evening, ladies and gentlemen. Welcome to Business Today Television. My name is Shail Bhatnagar, and you are with us for our special edition of Market Gurus, where individuals and professionals of exceptional talent and skill in the markets come and discuss what's going to happen in this wonderful and brilliant bull market that's unfolding in front of us. Our guest today is Mr. Tejas Gutka. He's a fund manager with Tata Mutual Asset Management Company, where he's been working for the past 4 years. And Tejas manages 3 funds, which is the Tata India Tax Saving Fund with about 3,600 crores, the Housing Opportunities Fund with an asset under management of 460 crores, and of course the Tata Multicap Fund, where about 2,470 crore rupees are invested. Overall, Tejas manages somewhere like 6,500 crores, and before joining the Tatas in their mutual fund asset management company, Tejas has worked with Barclays Wealth and Care Rating. Overall, with 2 decades of experience in stock picking, let's meet Tejas and understand his thought process. Tejas, welcome to Market Gurus, and it's such a pleasure to host you. One of the focusing things that you do is protecting capital and then participating in the upside potential of a stock or a market, which has been very, very rewarding over the past 6 odd months. But there are these clouds that are there on sentiment in the form of this impending war in the Middle East. Tell us, how do you see global sentiment and what are its impact that is going to happen on India?
Sure. Firstly, thank you so much for having me here. It's my pleasure being on the show. I think global sentiments are a little weak, so to say. I think a lot of moving parts globally. You have the entire growth recession challenge, you have the interest rate inflation tug of war, and obviously the geopolitical situation, right? And then its second order impacts on commodities and so on and so forth. So things are a little challenging on the global front, is how I would look at it. But I think things are a little different for India, right? We are an economy where neither is growth a challenge, nor is the inflation interest rate tug of war really too much of a challenge. I think broadly we know that our inflation is under control. We don't even have any geopolitical issues as such, right? So I think India is clearly in a very sweet spot globally, and that gets reflected, I think, in the flows that we see. Both domestic and foreign flows have been pretty strong in the last 6-8 months. So I think there is recognition in the investor community that here is an oasis amongst the entire world where there are so many other problems going on.
Right. So it's brilliantly put. India seems to be an island and an oasis of decent returns that we've seen across the investing landscape, whether it's mid caps or small caps. Let's just sort of get into the nitty gritties, and I'll first touch upon the macro. We've seen an all time low or near an all time low as far as the rupee is concerned. Lots of global pressures coming onto the currency, and the fact that a lot of our foreign friends are pulling money away from Indian markets for whatever their domestic contingencies are in the form of the US 10-year bond yield and of course the strength of the dollar. How do you see the rupee over the next 6 odd months, and what are the sectors that are likely to be impacted positively because of that?
So we don't really forecast on the rupee, and I don't have a very strong view, but I think broadly we know that the rupee depreciates over a period of time, and therefore it's not too much of a challenge, so long as we don't see a very rapid depreciation in a very short period of time, where I think the central bank has done a pretty good job over the last 5-7 years, in trying to smoothen out the volatility of the rupee. Given that we are a net importer, we typically, suffer a little more when the rupee depreciates quickly. A couple of sectors that really benefit are, the IT and the pharma sector, given that these are the large listed export spaces that operate in the country. But beyond this, most other sectors will kind of suffer because we import a lot of commodities for our own consumption. But like I said, so long as this is a 5-7% smooth depreciation, it's not too much of a challenge for the economy or for the earnings of the listed corporates.
Okay, fine. Let's now get into the sectoral representations as also the kind of rallies that we've seen over the past 6 months. Tejas, April to October. One of those wonderful periods on the mid caps and the small cap space. And of course, all your three funds have a fairly adequate representation of mid caps and small caps. The rallies have been fantastic. How do you feel when you see 20% circuits, 10% moves, a 60% rally in 1 week, and a doubling of stock price in say maybe a month or so? As a fund manager, how are you dealing with this fantastic rally that we've seen in mid caps and small caps?
So, like you said, I think we were adequately positioned for this, and we've participated well in this rally. Given in the current situation or given the current valuations, we've been a little more cautious, trying to manage the risk. So wherever we've seen very sharp, very high returns in a short period, we've been trying to reduce our exposures. I think overall, as a space, when you look at the mid and small cap space, the valuations are slightly on the higher side. The premium of mid and small cap to large cap is also now closer to all times high, and therefore it bears to be slightly cautious on this segment. That's the broad view. I think even when you look at from a sentiment perspective, right? So when you look at flows today, we're seeing some very strong flows in this segment. There's a very high retail participation. As you said, the velocity of stock moves has picked up significantly. I think all of these indicators kind of bear a slightly cautious view on these segments. So while we like these from a long term perspective, I think from a near term perspective, we think the valuations are a little expanded here, and therefore one's got to be a little careful in dealing with these segments.
Tejas, there are a lot of sort of questions which are a part of this overall theme. I've been looking at the portfolios at Tata Tax Saving Fund, your Housing Opportunities Fund, and of course the Multicap Fund. I see that there seems to be an absence of two or three specific sectors, which is of course the PSU segment, which has given phenomenal and stellar returns. As fund managers, you in particular are looking at capital appreciation coupled with its protection. So, is this a space where you'd rather stay away from, given the kind of disappointments that we've seen over the last 25 years when it comes to PSUs, or is this something that got missed?
No, in fact, we've participated quite well in the PSU rally. So, from the largest PSU bank to a large PSU power player to a couple of defense names, I think these are all part of our portfolios. In fact, we were very early in getting into some defense names. We've in fact been able to book some profits in the recent rally that we've seen because
Fair
we
point.
had gotten at a much lower valuation. So we've captured this rally pretty well. We think that at one point the valuations were screamingly low, and it didn't make sense as to why these businesses were trading at those valuations. Today we've seen a fairly big catch up of these valuations. We think that a large part of the valuation re-rating is now in the bag. From here on, the returns will be determined as to how these businesses continue to deliver in terms of earnings performance, and which is where I think we've got to be a little more selective. That big alpha valuation play I think is already done, and therefore the representation from these stocks is sort of has come off in the portfolios, but I think we are fairly adequately covered here.
Fair point. And, while we also speak to a cross section of fund managers, strategists, and other equity buyers, the common understanding as far as defense and a large section of the PSUs is that the easy money has been made. And from now on, you'll probably look at how sectors are going to perform from current levels, what the earnings and order book positions are going to be, and then maybe take a call. Is that the thought that's also resonating with how Tata AMC is now looking at these sectors, especially defense, railway, and the broader PSU theme?
Yes, you're right. Like I said, there was a point in time where some of these stocks offered So for example, when you look at PSU banks, right, these were all trading at less than half time book value. Some of the NBFC players were offering a very high dividend yield of about 8-10%. Right today, most of these are now closer to one time book value. The dividend yields have almost halved from those levels. So I think, like I said, the easy money or the big alpha of valuation relating is done. From here on, how the growth and profitability of these businesses play out is largely what will determine future returns, and therefore one's got to be a little more selective in where you're parking your monies, rather than being indiscriminate across the sector.
Fair point. Let's look at the profit that you've booked. Like I mentioned, somewhere like 6,400 crore rupees is what you manage under three funds, and it's the Tata India Tax Savings Fund and the Multicap Fund, which account for the broad chunk, about 90% of this money. How are you positioned in terms of cash, given the kind of rally that we've seen? Holding cash is a strategy for you, or is this to do with trying to buy an unforeseen dip that has come into the market? What is the percentage of cash that you manage overall in terms of equities and the uses thereof?
So cash is more a function of our bottom up stock picking rather than a top down call. So we're not we don't take a market call and say, let's raise cash because we think markets will come off. Cash is typically increase or decrease depending on how the how many opportunities are available. Like I said today, that opportunity set has reduced while large caps are still reasonably valued. We think mid small caps are slightly expensive, and therefore incremental opportunities to deploy those monies at reasonable valuations have come off. So cash levels have gone up. So wherever we've booked profit, we've not been able to redeploy all of those cash. So today, cash is more like 4-5% of the portfolio. They've typically averaged about 2-3% of the portfolio. So we are slightly,
Okay.
higher than what we would like in terms of cash in the portfolios.
So that's a fair point. I mean, given the ferocity of the rally and the fact that you know it's to do with also booking profit notionally, and not only notionally, but as the famous saying goes, profit in the bank is better than profit in the book. That's a fairly sensible strategy to follow. Tejas, given the fact that we've rallied so fast and in such short an interval, I'm sure it's an enviable job, unenviable job for you to find out fresh areas of deploying this capital that's coming in the form of SIP, and as of course the cash that you've raised. Where do you see value in the market at this moment?
As the saying goes that in every market there are certain opportunities. You've just got to work hard to find those opportunities. I think even in the current market, we still find some reasonable opportunities. Especially in the cyclical sector. So for example, when you look at the largest sector of the economy, right, banking, it's a sector that still trades at average valuations from large cap to mid and small cap banks. Nothing's really expensive in this sector, and therefore, and it's a large sector, right? A fairly wide sector with a large number of stocks and a large representation in the index in terms of weight. So there are enough opportunities to deploy monies there. Some of the building material and industrial segments where you have interesting manufacturing oriented companies are also available at reasonable valuations with very very good growth profile, right? Similarly, on the cap good side, the largest cap good company is still at a very very reasonable valuation. So there are these pocket of opportunities that we continue to find to deploy monies. Auto ancillaries is one space that we think has a lot of interesting names to offer. While the OEMs have run up very very sharply, we think the ancillaries are still available at reasonable valuations, which much better growth profiles that these ancillaries have demonstrated now over the last 10 years, right? So there are these multiple pockets. I think if I had to bunch all of this, the way we look at it is, all the cyclical sectors of the economy are seeing good earnings recovery with reasonable valuations, and there that is where our portfolio is a little more tilted compared to the more structural sectors, which is your typical consumer, IT, and pharma segments.
Fair point. And if you look at the multi-cap fund, where Tejas has a lot of flexibility across market caps. The main emphasis is actually auto ancillaries. I'm sure Tejas will not comment on individual stocks, but I have the flexibility of naming them what is there in the portfolio. There is Samvardhana Motherson International, Craftsman Automation, Uno Minda, Varroc Engineering. Tejas, when we see this broader trend that's emerging in the auto OEM space, Tata Motors at a record high, a very strong breakout. Maruti announcing an 8-year expansion plan of about 45,000 crore rupees, in which it is doubling capacity. What is the underlying granularity of this market in terms of change that you witnessed, and what is in the pipeline for at least investors?
So, like I said, I think the OEMs are a little more well discovered today. More importantly, I think when you look at the product cycle, I think all of these OEMs are sitting at a very healthy, product cycle in terms of product launches that they've already done. The incremental cycle looks slower. Typically, OEM earnings are driven by your product launches, and that's when the earnings accelerate much faster than average when you have a lot of new launches coming up. For most of these guys, I think that product cycle, we're probably more than halfway through that product launch cycle, which is why we've preferred ancillaries to OEMs, where we think that the earnings growth will continue at a faster pace. More importantly, when you look at the OEM space, everybody has fits into one particular bucket. Ancillaries give you exposure to multiple buckets. OEMs have threats of, let's say, someone has a threat from SUVs or entry level vehicles not doing well. Someone has a threat from EVs, and so on and so forth, right? Ancillaries straddle all of this together, right? Most of the ancillaries that we hold have about 30-40% of their order books coming from EV, and the rest from the traditional ICE engines, right? So the risk of technology is much lower in some of these ancillaries. The valuations are more palatable here, and therefore the representation of ancillary is higher in the fund compared to OEMs. It's not that we don't own the OEMs. We do have a couple of OEMs in each of the funds, but ancillaries have a much higher representation than some of these OEMs.
Yeah, that's a fair point to raise. You'll probably invest where you see more potential in terms of capital appreciation rather than popular names, and that's how stock picking is done. Uh, how about housing? You have a fund in the name of Tata Housing Opportunities Fund, about 460 crore rupees in assets under management. It's a theme that's come back very, very sharply in the markets. How would you sort of look at this real estate space? Since this is a sectoral thematic fund, let's discuss, does it make sense to be in builders, or does it make sense to be in housing ancillaries like paint companies or even cement plays or even construction giants? The overall picture of housing, how does it look to you?
Sure. So, this is a thematic offering where we are trying to capture the housing cycle. We have a pretty long housing cycle in India, typically 7-8 years of a down cycle, followed by 7-8 years of an up cycle. We think we are very early in that upcycle. Probably a couple of years have only passed now in the upcycle. So there is a reasonable runway from here for this cycle to play out. And hence this offering that we came out with last year. The reason that we have a higher exposure to ancillaries here compared to some pure play real estate companies is twofold. A, obviously, the ancillaries being consumer facing businesses are much better in terms of quality. So balance sheets are very lean. Return on equity or cash flow generation is very, very high. More importantly, we think the ancillaries offer much lower cyclical risk than the pure play real estate companies, right? We know real estate goes through deep up and down cycles. So in a down cycle, there could be a lot of risk to investors' capital, and which is why we think ancillaries are better play, because there's an inherent replacement demand, right? You'll buy a house maybe once, twice, or thrice in your life, but you'll redo that house every 5 years, right? So the ancillaries have a certain base demand, and therefore they don't see degrowth in a bad cycle. So we think that the ancillaries offer much better downside protection and a much better quality of business. So that's how we've designed the portfolio, smaller allocation to pure real estate companies and much larger allocations to all the ancillary sectors, cement, paints, tiles, plywood, and so on and so forth. About 8, 9 industries that represent the portfolio. It's a fairly concentrated portfolio between 25 to 30 stocks with a good mix of large and mid cap, about 50-55% large cap allocations and the remaining in mid and small cap allocations. So it's a very well
Yes.
balanced portfolio, so to say. We think the growth runway is pretty large. Like I said, these are most consumer facing businesses. The sizes are very small today. There is a large unorganized markets in most of the categories. So there's a very long growth runway for some of the branded companies where you'll have a first round of the unorganized shifting to organized and then the market consolidating. So there could be a good 10-15 year of growth runway where the top line will grow at a decent pace faster than the GDP, and the margins will slowly and gradually expand as these businesses gain size and consolidate the industry. So we think
Right.
that the sectors offer us superior return opportunities over the next 10-15 years.
Fair point. And within the housing opportunities sector, of course, Tejas is playing it via the financial services and the private banking space as well, where you look at the loan portfolio and all. But if you look at some of the names that Tejas has in his portfolio, they are very, very popular names and popular stocks. There's Voltas, Asian Paints, Kajaria Ceramics, Havells, Serra, Blue Star, and amongst the industrial products, blowout stocks like Polycab, which hit a new high today. Then you have KEI Industries, which makes wires. Of course, Supreme Industries, Astral, as well as RR Kabel. So it's I think you pretty much have the entire wiring portfolio within this space, and it's only relative that you can say that KEI or Polycab has done better, but across the space we've seen stellar multi-bagger returns coming in. Let's just shift focus and come to banking. I see that across the three funds that you manage, banking has the heaviest weight, and that's mainly on account of how banking overall in terms of index also gains importance. There's been a bit of a disappointment, of course, in hindsight, with the largest private sector bank, that the merger doesn't seem to have benefited medium to long term shareholders. This particular stock is the highest weighted across all three of your funds. One, how do you feel? And two, what's the way out?
So you're right. So far it's been a little iffy butty as far as the merger is concerned. The reason you see this as a very high weight in the portfolio is that the weight in the index is even higher. So when you
Yes.
compare it to the index, we are actually slightly lower weighted in the portfolios. Having said that, I think a lot of the merger-related volatility is now behind us. I think incrementally from here, things will start looking well. Even in the quarterly result call yesterday, they mentioned that they've taken a large part of the hit upfront, and things should start looking better from here on. You can't deny that this is a fantastic franchise that's been built over the last couple of decades, and the delivery on the business
Show
front has been very,
HDFC
very
Bank.
good. And I don't think you can. This is not a business that you can really ignore in your portfolios, and I think the delivery from here on is going to get better and better over a period of time.
Yes, and to the uninitiated, while we did not take a name on the stock that we were discussing, it's HDFC Bank. It's been a multi-bagger stock over the last 1995 it got listed, so that makes it nearly 27 years. And some parts of those 27 years, the bank has remained quiet in terms of shareholder returns. Perhaps we are passing through that phase, but the fact remains that as a fund manager, you have to mimic the index that you are trying to beat, and that's the reason why all three funds that Tejas has have the highest weightage to HDFC Bank. Let's take this conversation forward, Tejas. We are in some kind of a Goldilocks environment when it comes to Indian markets and returns that we've seen over the last 1 year. You yourself mentioned that it's an island or an oasis of plenty. That's worked out pretty well for fund managers, for investors, as well as people who make SIPs. What, in your opinion, is likely to derail this, if at all?
Yeah, so I think risks on the horizon are a few, and they as of now seem to be more external than internal. Although I think we have a very large event in terms of the elections coming up, but I think the number of risks outside India are probably today larger than within the country. Commodities is one of the biggest risks, right? With whatever escalations that we're seeing across the world in terms of geopolitical tensions. If there is a very large spike in commodities, especially crude oil, then that creates a challenge for us in terms of balance sheet as well as profitability issues for the corporates. Similarly, when you look at the developed market yields compared to the Indian yields, I think the gap has narrowed. Even the equity yield in India is today at a very very low premium to the developed market yields, and those kind of things clearly add some pressure to the domestic markets, either in the form of flows or currency or overall risk premiums that investors would want to look at in terms of the Indian equity markets, right? So I think these are some of the external risks that remain to the Indian markets. Not to mention, if there is a severe recession in any of the developed markets, that will also have repercussions on Indian markets. Even though we continue to remain an oasis in terms of growth, sentimentally it will definitely impact the markets.
Yes, that's something very well put, that at the moment the risks to Indian markets are more external than domestic. And I'm sure a lot of long-term shareholders are actually looking that as a very positive move, because things in India at the moment are, like I said, in a fairly Goldilocks kind of a scenario. We haven't seen this happen over the past 25 years. My last question to you, Tejas. While we see markets compounding normally at about 15 to 14 to 17% CAGR over the long term, expectations, especially now and among the younger breed of investors, are fairly on the higher side. How do you sort of, convince people that this possible rally that we've seen over the past 7 8 months is a statistical abnormality and it's not going to be how it was?
Right. When you look at the longer term numbers, you kind of see where these numbers stand, right? I mean, there is a reason the averages are at about 13 to 15% and not at 20-30%, right? So I think it's important that we pay more attention to these longer term numbers, and in all our conversations quote the longer term averages rather than the short term aberrations, and that's how we try and manage investor expectations, right? I mean, if the earnings are growing at 13 to 15%, or if the nominal economy is growing at about 11-12%, you can't have returns that are going to be very very far away from those numbers, right? Especially when your starting valuations are already at average or slightly above average.
Right. So, ladies and gentlemen, that's how sensibly you look at markets. The long term average of returns of somewhere like 14, 15, 16% is the hard truth and reality. Anything over above that is a gift from the market, which should be accepted with due humility and not presumed to be a change in the long term average. Tejas, with that, we'll call it a day. What a wonderful 25, 26-minute conversation we had. And let's hope that things turn out to be better for Indian markets, and especially for your SIP holders at Tata India Tax Saving Fund, Tata Multicap Fund, and Tata Housing Opportunities Fund. Thank you so much for your time.
Thank you.
That's it, ladies and gentlemen. This special edition of Market Gurus focused on fund manager Tejas Gutka. He runs 3 specific schemes at Tata Mutual Asset Management Company. Overall assets under his management are 6,500 crores. I hope you enjoyed the show. Please remain glued to Business Today Television for all your news updates and financial requirements from Indian markets. Thank you for joining us.
The big launches from Google to the festive sales here in India and all your tech